Welcome to Policy on Demand. I'm Kevin Levingston. The government's recent CAMT guidance is intended to be good news for companies. The IRS stated its intent to partially revoke the 2024 proposed CAMT regulations, provided interim guidance on the application of CAMT. Revised proposed regulations are forthcoming. So what are the implications on policy and next steps for companies? Here to answer that question are Brett York and George Manousos. Brett, George, welcome.
Good to be with you, Kevin.
Happy to be here.
George, why don't we start with you? What would you say is the one big takeaway from these CAMT notices?
Well, Kevin, to me, the biggest takeaway to me is Treasury really demonstrating a receptiveness to commentators' request for simplifying rules to ease about the administrative burden and the complexity of CAMT. The notices introduce a lot of new AFSI rules, and as taxpayers begin to go through the notices and see the different adjustments that are provided, they're going to realize that the computation of AFSI is slowly creeping a bit closer to a taxable income determination. Now, much of the guidance in the notice is not found in the statute, and it's the result of Treasury really listening to taxpayers' concerns expressed in the numerous comment letters they've received, and really demonstrating a willingness to address those concerns through things like the notice and the proposed regs as well.
Great. Thanks, George. So Brett, how does the notice impact the reliance upon proposed regs and future guidance?
Oh, in a number of ways. I mean, the proposed regulations generally did not permit any form of cherry picking and required sort of an all or nothing approach to certain chunks or larger sets of the proposed regulations. In particular, they required the adoption of a set of proposed regulations termed specified regulations in the preamble to the proposed regulations. There was a large number of general rules and also a large number of international rules. And some of those rules were very negative. For example, the specified regulations contained unfavorable CAMT foreign tax credit rules that generally applied all the limitations that apply to foreign tax credits for regular tax purposes, unfavorable rules on related party transactions, and rules that imported Section 42 principles into CAMT. The specified regulations were also proposed to apply to taxable years ending after September 13th, 2024, the date of the proposed regulations. So the notices alleviate that burden for the most part and allow a taxpayer to rely on any section or section of the regs as they choose. It's a very helpful and welcome change. I think a lot of companies are very happy to see that. The only exception to that flexibility is that to rely on the section specific to foreign corporations or controlled foreign corporations, you have to also rely on a section that addresses AFSI adjustments for foreign and federal taxes, which is not, I think, that material of an issue. But unfortunately, you also have to rely on the CAMT foreign tax credit regulations. For that purpose, they largely retain the broad exclusion for foreign taxes subject to any regular tax limitations contained in the proposed regulations. The only change is that if a foreign tax is not eligible for a CAMT foreign tax credit solely because of Section 245 Cap 8D, the foreign tax credit is no longer limited for that purpose. The notices permit taxpayers to rely on the CAMT proposed regulations, generally on a section-by-section basis. Back to the first year CAMT was applicable in 2023. So you actually could amend prior year returns and apply, the chosen set of proposed regulation sections to those earlier years. Finally, and I think this is actually one of the most important things in the notices, they make it clear that no section of the CAMT proposed regulations will apply and no future proposed regulations will apply to a taxable year beginning before the date final regulations are published. So we have clear direction that the rules are going to be applied prospectively and not retroactively. That's extremely helpful. Many companies had worried that the Treasury Department might ultimately keep the taxable years ending after September 13, 2024 applicability date for those specified regulations.
All right, so on balance, some positive news and as it relates to reliance. George, looking beyond that, what are the other pieces of really good news for taxpayers as part of the notices that came out?
Well, I think first and foremost, as Brett noted, is the lightening of the rules and flexibility in relying on desired aspects of the proposed regs, desired aspects of the notices is certainly welcome relief. In addition, as I mentioned earlier, there is a bunch of new AFSI adjustments that are found in the notice. I think three big ones that stood out to me were a new one for Section 197 goodwill amortization. This is limited for transactions that were announced or closed on or before October 20th, 21, which is the date that the House first introduced the legislative text of CAMT. So any goodwill amortization that rose before that date, that's now an AFSI adjustment. Certain repairs deductions, but only for certain regulated industries. So a little movement there in a positive direction for some taxpayers, not all the way, but we're slowly making progress. And then lastly, a big one was financial statement mark-to-market adjustments are now generally excluded from AFSI unless you also mark the item for tax purposes. So that's very welcome relief for a lot of taxpayers.
George, there was a lot of noise on that and a lot of comments around mark to market. Was this the answer to everyone's prayers?
Yes, no, not everybody, right? There's always people on both sides of the fence. There's some people who wanted mark to market in there in case they had a book marked down for something, so that reduces your AFSI. So that's a good answer. There's also some exceptions, like anything, to these rules. Impairment losses for books stay in AFSI, are not allowed. That is not a reversal. And certain partnership and stock investments that are marked are also disregarded for purposes of this rule. So there are some nuances to the mark-to-market adjustment, but on balance, good news.
What about the bad news, Brett?
So there are a number of things, but they're not major, but there are a number of things here. Not all taxpayers wanted book mark-to-market excluded in the event they had losses that helped them from an AFSI perspective. As George mentioned, there's a fair value item exclusion election under which book gains and losses related to book fair value adjustments can be excluded from AFSI if they are unrealized for regular tax purposes. Now, while that election is extremely helpful and well received, I think an important thing to note is that it only applies for the 2024 and later taxable years. So the election may not help for testing whether a corporation is an applicable corporation subject to CAMT until more years have passed. That's because that status is tested based on the average AFSI over the previous 3 taxable years. So as a result, the first year the election could help with applicable corporation status is really the 2025 year. I think another point to make just about the notices is there are some limitations on helpful news in the notices. For example, the adjustment for tax deductible repairs is very limited in scope. It only applies to a certain subset of regulated utility company assets. It doesn't apply more broadly. A lot of the comments had asked for an expansive rule that provided that all tax repairs would be an AFSI adjustment for CAMT purposes. On the goodwill amortization rule that George mentioned, while the adjustment's extremely helpful, as George noted, it's only applicable for transactions announced or closed on or before October 28, 2021. And it's limited to just goodwill. It doesn't apply to all Section 197 amortization. Many had been hoping for an adjustment that would apply to all goodwill amortization or even all Section 197 amortization, and we didn't see that in this notice. I think another point to make is that many of the adjustments in the notices do not apply for applicable corporation determination purposes. So taxpayers are going to have to compute 2 calculations, one for determining whether they're in scope for CAMT and another to determine what their liability might be. For example, the repairs adjustment we talked about doesn't apply for applicable corporation testing purposes. Neither does the goodwill amortization AFSI adjustment we talked about. And as I mentioned, the fair value exclusion election does apply for that purpose, but only for the 2024 and later years AFSI. So you have to wait at least till the 2025 year for that to have some impact. Another thing that people were looking for that wasn't in this set of notices was whether it would be a new rule for purchase accounting or push-down accounting. In the context of an acquisition, book purchase accounting and push-down accounting essentially adjust the basis of assets in the target corporation to their fair value at the time of the acquisition. The CAMT proposed regulations ignored those adjustments in the context of stock acquisition or an acquisitive reorganization. So that generally resulted in a carryover basis for CAMT purposes. Now that rule creates a lot of administrative burden because you're no longer looking to what's on the books of target to determine your basis. You have to adjust for the ignoring of purchase accounting, and it can impact AFSI at the target moving forward. So there were a number of comments asking that the CAMT proposed regulations be modified to respect purchase accounting and push-down accounting. We didn't see that in the notice. In fact, the notice reiterated the same role that proposed regulations had on purchase and push-down accounting.
Okay, all right, great. Well, what's expected in terms of future guidance? What can we hope to look forward to?
So I think there's a couple of things. First, the notices don't account for any of the OB3 provisions. So we might see some additional interim guidance with respect to OB3 issues, both with respect to implementation of OB3 itself and possibly the interaction of various OB3 changes and other code sections with CAMT. For example, the notices did not address the intangible drilling cost AFSI adjustment that was included in OB3. And we are also aware of a number of comments going into the government asking that the Section 174 Cap A catch-up adjustment, that's for unamortized R&E from 2022 to 2024, be an AFSI adjustment. It's also possible there could be additional interim guidance if the Treasury Department receives additional comments that they think should be addressed in a timely fashion. After any additional interim guidance, we should expect to see proposed regulations issued, I think probably sometime next year, although we'll have to see. Then we'll have to have a comment period after those proposed regulations are issued. There will likely be a public hearing associated with the proposed regulations. And then the Treasury Department and IRS will have to incorporate changes based on the comments they received. And all those steps take time. I think the other point is that CAMT regulations take significant amounts of time to draft and issue because they touch on subject matter covered by most of the divisions of IRS Chief Counsel. And so that requires a lot of coordination and a much larger group of working attorneys to get the work done than you normally see in a guidance project. So I think that's going to make it take longer than you'd normally see in proposed reg and finalization process for most regulations. After the proposed regulations, comment period and public hearing, you would expect to see some final regulations to be issued possibly by the end of 2026 or in 2027, I think. And in the interim, we encourage taxpayers to continue to provide their comments and requests for guidance to the government because they've clearly shown a willingness to listen and to address issues that create undue burden on taxpayers.
Okay, that's great. Brett, George, thank you both for joining us here today.
Thanks for having us.
Our pleasure.
For more on CAMT, don't miss PwC's Tax Readiness webcast on October 27th about CAMT Beat and more. There's a link to the register for the webcast in the description of this episode. Thank you for spending this time with us and take care.